How do trusts impact a deceased final tax return? Have you ever wondered how trusts affect the tax responsibilities of someone who has passed away? This is a common question in estate planning and probate processes. Let's break it down step by step. When a person dies, their final individual income tax return must be filed. This return covers all income earned up to the date of death. Trusts, especially revocable living trusts, play a significant role in this process. A revocable living trust is an estate planning tool where the person who creates the trust, known as the grantor, keeps control over the assets during their lifetime. For tax purposes, the grantor is considered the owner of the trust assets. While the grantor is alive, any income generated by the trust assets is reported on the grantor's individual tax return. This means no separate tax return is needed for the trust during this time. However, things change after the grantor passes away. At that point, the revocable trust typically becomes irrevocable. This change means the trust may need to obtain its own tax identification number and file a separate income tax return, known as Form 1041, for any income generated after the date of death. Now, let's focus on the deceased final individual income tax return. This return includes all income earned by the individual up to their date of death. This can include wages, interest, dividends, and even the grantor's share of income from partnerships or S corporations. For instance, if the deceased was a shareholder in an S corporation, their share of income, losses, deductions, and credits must be reported on this final return. After the individual has passed, the estate itself may generate income. This can come from assets held by the estate or trust. If this income exceeds a certain threshold, typically $600 or more annually, the estate or trust must file its own income tax return using Form 1041. This return addresses income received from the date of death onward. For the executor or administrator of the estate, there are specific duties to consider. They need to gather all income information up to the date of death for the final individual tax return. Additionally, they must ensure that any income generated by the estate or trust after death is reported correctly on the estate's or trust's tax returns. This requires careful coordination because trust assets may pass outside of probate, but the income they generate still has tax implications. In summary, the deceased final individual tax return reports all income up to the date of death, including income from trust assets, while the grantor was alive. Revocable living trusts are disregarded for income tax purposes during the grantor's life but become separate taxable entities after death. The trust or estate files its own income tax return for income generated after the decedent's death. Executors and trustees must manage these filings to comply with tax laws and properly administer the estate. Understanding these responsibilities helps ensure that tax obligations are met accurately and that the transition of assets through trusts and estates is handled in accordance with tax and estate laws.